Hey guys, welcome to another Trade Genius podcast. Bob and Phil here. Guys, did Japan just take away the punch bowl from the party? We're going to talk about what's going on in the markets today. Let's dive in.
Trade Genius.
So Bob, Japan raised rates, what was it, 0.15 basis points or something like that. Kind of a surprise move. They haven't done that in decades almost, I think. So, now we're seeing a lot of volatility in the markets. So what do you think is going on right now?
Yeah, I mean, let's set aside the Fed meeting for a second. Is that I think this is huge move. Now we have basically the last two carry trade countries aren't carrying any trade anymore. And so, and Japan owns a lot of our high alpha and high market cap stocks. And so if they start exiting the market, and they're kind of at resistance now, Phil. So this could be a moot point by Monday, right? And this could just be a Fed reaction. But if it breaks up any higher, I think it destroys the narrative of a blow off top for us. And I think we hit the top in July. That's my view. Let me show you the chart here. I guess it would be more visual if I could show this to you. You see that line that's going across the top of all the price action there? That's that resistance I'm referring to you. And you notice earlier in the year we hit it, and the Bank of Japan went ahead and basically try to dilute the yen's value. And so if they don't do it here, Phil, and we end up making a higher high, then I think the party's over, and I think the seasonality gets busted, and I think the narrative for a blow off top gets busted too. What do you say?
Yeah, so you got to be adaptable in your views, right? I'll take a look at the SPX chart. Okay, so we know the yen's in play and affecting markets because of the carry trade. And Bob, for the folks at home, the carry trade is borrowing the yen super cheaply to invest in other products. Yeah.
Yeah. So you borrow yen, you buy stocks because the value of the yen is going to keep falling. So you're buying stocks in the US dollars and you get a twofer. And so then when you repatriate those trades, you gain value because of higher currency and higher stock price, which you cause by doing a carry trade. And it works in reverse, and in reverse, it's violent because people, fear is a more powerful emotion than greed, and people will panic out or they'll be forced out of the market by their brokers. So that's what a carry trade is. And we're out of it. The United States carry trade's been over, and Japan's is the last one. Hey everybody, it's Bob with Trade Genius. Usually I do fun ads. I talk about our service, but I want to be serious with you for a second. We've been helping a lot of people trading for a long time. As you can see here, I want to let them do the talking for me for a change. But most importantly, we want to help you too. If you've not joined our service yet, come check us out, tradelikeagenius.com. Full service. We have chat room. We have the algorithms for you. We give trades out every day. We educate you. So go to tradelikeagenius.com. Check us out. What you get out of our service is much, much more than what you put into it. And we'd like to see you in the room. Thanks for listening.
Yeah, so if that trade's blowing up, there can be some systemic problems. But to keep things in perspective and not get too crazy, I brought up a chart here of the S&P 500. And what you'll notice is that I've got 3 arrows on there, and they point to that green line. That green line is just a simple 20-day moving average on the S&P 500. When you lose it and you come back up from below and you test it, oftentimes there's a rejection. Okay, so that is what essentially we just saw over the last day with the reaction up into the Fed announcement and then the reaction back down here today. And yesterday when we were streaming, I said, we got to be careful up here at the 20-day moving average. We could overthrow it a little bit, but then we're going to come back down. It's exactly what happened overnight. We overthrew it a little bit, and now today we're getting a big reaction off of it. So where do we go from here? Well, there's a couple things. One would be that we hold the lows, but the way that the futures put their low in the other day is like a double bottom, and markets like to clean that up. So that means lower lows. And typically when these markets pull back, it's either going to be shallow, like a 2 to 3% pullback when we're in a big uptrend, or you're going to get a deeper one that's around 5 to 6%. If we get the 5 to 6% variety, Bob, then we're going to fill some of those unfilled gaps that we have there on the chart. And that's going to take us down below between 5,300 and 5,400 on the S&P 500. So I think if we're going to dump down in the next couple of days, and look, 2 more days like this and we're going to be down there. So we could get this out of the way early, and then you get a relief rally up into OPEX toward the middle of August. Because remember, seasonally, now again, maybe there's something systemic going on with the yen, but I would watch if we start going down hard, because this market if it goes down violently, it tends to bounce violently, especially when we're in what's called negative gamma, which means price can be very, very slippery due to the way that the option dealers have to hedge their books. So right now they're trading with the market, meaning that as the market's going up or down, they're trading with that, adding more momentum to these moves, and it gets much more violent. Versus in a positive gamma environment, they're actually trading against price, hedging against price, which makes things a lot less volatile. So negative gamma, we're falling, breaking supports here. I think they're probably going to clean up those lows myself, just the way that the futures look on the bottom there, which means that we might be into the camp of a 5 to 6% correction here. Now, getting that, I wouldn't get too bearish, because with the seasonality and things like that in effect, you could have a very violent move back up. And then at that point, Bob, we have to really look at this thing and say, are we in an environment now where we're seeing lower highs, or is this just one of those pullbacks we're going to get similar to what I have here on the chart back in, I believe it was April there, right? 6% pullback. And then we started reclaiming all the key levels and we made a new high.
Yeah, I mean, bear in mind, most of the price action to the good has been when companies can buy back their shares. So to the extent they can continue to do that, we should get rolling into next week, like you said, the OPEX should be generally positive. My comments are really based upon, are we going to make an new all-time high? And I'm less and less confident. I would say if we make an all-time high by the OPEX, then I think we're still knee deep in the camp of seasonality. And if we don't, then there's more fear and there's more concern in the markets right now. So that's kind of where I'm sitting at, Phil. I totally agree with you. We have gaps to fill. We can't be so bearish, but I think, like I've been saying for weeks now, any pops you get in the markets here, you're going to just get more and more defensive, because I think for sure, I could say with almost certainty that 2025 is going to be an awful year.
Yeah. And a simple way to look at this is that you can't really have a bullish case unless you're trading back above the 20-day moving average on the S&P 500. So basically, we have to get back to levels that we saw yesterday going into the FOMC announcement. And it can be as simple as that. So Guys, let us know your thoughts on today's content. Let us know if you think we are heading for lower lows, or are we going to bounce here and make new highs going into August. Thanks for watching, guys. We'll see you on the next podcast. Take care.
Trade Genius.